By any metric, to any investor's eyes, Tender is the more valuable asset here. The market caps are moving in opposite directions, and we see this simply as offering a dinosaur a digital future.
Why am I here negotiating something I assumed had already been negotiated?
This isn't what this is. We wanted to illustrate how amenable we've been in the hope of asking you to solidify the partnership with a further $1 billion investment.
I'm working on a follow-up. Far more meat on the bone. Major discovery in Sunderland, right?
Well, I don't like being woken by bullies. And it's in the public interest for us to respond aggressively, especially if Tender have designs on the UK consumer with this new banking app. I'll get legal to word a stern and curt rebuke. If I know anything about people who go this nuclear this early, you can bet your loneliest penny the cunts of a glass fucking jaw.
Yeah.
Okay, bye.
And this situation, it's worth explaining really what's going on. And in this situation, they have leaked a story to a journalist, or an idea of a story, and the journalist's gone and done some investigating, and they've figured out that there's some serious problems with the company, in this case, Tender. But actually this happened in lots of different situations before, where hedge funds have published research, or journalists, and probably the really biggest example of this is Wirecard, which is a German company, where an FT journalist wrote a piece about how the whole thing was a house of cards. There was enormous pushback, even from the German regulators, about that. But eventually this came true. Now, what the hedge funds will do in this situation, they will take this stock and say, hey, this is a really bad stock and it's overpriced. So we're going to borrow the shares from someone and immediately sell them. And that's what the short trade is. So the idea here is they are shorted Tender, which means they have borrowed the shares and sold them, and they need to be able to buy them back, but they want to buy them back when Tender's stock price has fallen. So they need to get this piece out into the market to display that this is a house of cards and things are going to go bad. Now, there's a kind of fine line here between market manipulation. You really need to make sure all investors have that information equally. So this does happen, but you need to be careful.
You want to give us a state of play, please?
Yes, sir. 250 million assets under management. Eric's 5% of fund, $10. Pierre, the anchor, $100. Further 140 million when we combine all other invested parties. With Kenny as our primary broker, we borrowed a further 250 million via Deutsche. That's our margin.
100% gross leverage.
Yes, 250 million equity, 250 million margin.
So in this scene, you're seeing Bannerman explaining their trade, which is a short trade. And they have invested 500 million in this short trade. And they've done that by doing two things. They've got a 250 million down payment, and then they've got 250 million on margin, which is essentially a loan. And what they've done is they have borrowed the stock from an investor, and then they have sold the stock. And that means that they are essentially on the hook to be able to deliver the stock to the people who they originally borrowed it for, and they don't have it. And the idea is that in the future, what will happen is that they will have to buy back the stock at a much lower price than they originally sold it for. And let's say they sold it for 100 and the stock declines to say 30. They buy it back at 30 and then return the shares to the original investor. And they have originally sold the stock at 100. They bought it back at 30, so their profit is 70. Now, when you do a trade like this, no one is going to just allow you to do the trade without any kind of deposit to make sure that you are good to be able to deliver the stock back. So the person who's lent you the stock will require some kind of deposit. And this means that you have to have kind of money down to be able to assure them that you're going to be able to buy the stock back. Now, if the trade starts going against you, and this can happen where the stock price rises rather than falls, then the person who lent you the stock often will require you to make more of a deposit, and that's known as a margin call. So it's pretty risky because actually there's unlimited losses in shorting because the stock could go sky high. So it is pretty risky and you need to know what you're doing.
Henry isn't happy about how the app launch is being positioned.
Because your husband hasn't landed on something he likes. Robin says you want to eventize the launch?
Yeah, there should have been a runway laid to eventize it from the start.
Oh yeah, stop using the word eventize like it's a serious word.
I don't think this is funny. You know, if I had a proper job title, a role in the comms department, this would have been done properly.
You want to work directly under Robin?
I want to give Henry a pulpit.
If Henry wants to be prominent, if he wants to be responsible for this, I'm not going to get in his way, but I'm a little disappointed in him. thought I was hiring a rock star. He was like a fucking ghost in our meeting with PRA.
Yeah, his confidence is coming back.
Slowly.
Here, they're talking about something called the PRA, and what that stands for is the Prudential Regulation Authority. In finance, there are two kind of pillars of regulation. One is the Prudential Regulation Authority, and essentially what that does is make sure that there's enough capital or kind of cushion that financial institutions have, that if there's a crisis, that they have enough cushion to make good any losses. And typically in banks, it's protecting depositors. The other side of regulation is the Financial Conduct Authority, and that really kind of looks after primarily things like consumers' rights and making sure that people don't do bad things. Now, in this case, they're worried about the Prudential Regulation Authority, making sure that they have enough capital, and there's often not just capital, but there's kind of good character and things like that that will require you to have before you get a license for even being a bank or a payments company, anything like that.
Meteoric overpromotion even for a white guy.
And look at this.
When have you ever seen a $50 million acquisition closed with a novelty check? That's what they paid for this third-party processor, SwiftGC. It's artificial, right? Like gut read.
Presentation is pretense.
He looks like the hated chairman of a lower league football team, not the CFO of a multinational payment processor. It's a big song and dance. It's cheap.
I wonder if anyone's flown to Accra and knocked on their door.
Now, in this section, they're talking about the novelty check. Now, I do agree with them. This is kind of weird because normally when you make an investment, you wouldn't display a big novelty check. That's the kind of thing that you see in lottery winners. Usually, when a deal closes, if it's a merger and acquisition or even sometimes financing, you get what we call a tombstone, which is a perspex block, and inside it will announce the deal, and sometimes it will have things embedded in the block. So I've seen oil deals where they have literally had a bit of oil embedded in the block of perspex. So that's a much more common thing, so it would be unlikely for you to see a kind of this novelty check. So they're absolutely right on that score.
You wanted to see us?
Yeah, I did. I want to propose a reshuffle. Gaz is going to be co-running communications for us going forward.
On what grounds?
Forward-looking ones?
Whitney, you know I won't stand to share the post, especially with someone so ill-qualified.
I think qualifications are secondary to instincts. I also anticipated that you'd have too much pride to share the post, in which case, yes, if you'd like to do the honors.
Do what?
Your first task is our new head of communications.
I don't follow.
Let him go. Fire him. Dismiss him.
She doesn't have the power to do that.
Well, she does if she accepts the post. Do you accept it?
I do.
She accepted it, so.
We can work together.
I don't think we can.
Right, so I guess we're dismissed then.
You're kidding me, right?
You're a little bit, trad.
So in this scene, we've got Whitney sitting at his desk with Yasmin and Robin, head of communications. And it's just worth kind of explaining how this is unlikely to happen in a financial institution where Whitney promotes Yasmin to head of communications over Robin, who is currently head of communications, and then Yasmin turns and fires Robin. Now, this genuinely wouldn't happen, certainly in the UK it wouldn't happen because it would be constructive dismissal. Firstly, promoting somebody to do the same job as somebody who's there as a kind of co-person, that would be what we call constructive dismissal. And then somebody firing somebody without any cause or any due process or anything like that. You can have what we call a discussion about somebody's role and say this is not working out. But if you do that in the UK, you need to say this is a without prejudice discussion. And typically that involves quite a significant financial payment to let someone go without all the kind of due process that you go through. But so this is really unlikely to happen in the modern workplace, certainly in the United Kingdom.
So I just got off the phone with Wilhelmina, CEO of Almirage Pierpoint. They offered the financing we asked for in form of a COCO, a contingent convertible bond.
So they're protecting their downside if they've seen something they don't like?
It depends how you look at it. It's a good bridge. When we grow our deposit base, repayment only gets triggered if stock falls beneath a certain threshold, which we know it won't, not with the momentum we have.
Yeah, well, given how distressed an asset Pierpoint is and how readily Almirage wants rid, it might be smart to deploy some cash, silently buy some equity, and it gives us leverage in the partnership longer term, means we can finesse them a little.
So in this situation, they're talking about a COCO bond. And COCO bonds are reasonably common for financial institutions. And They're unusual because they're a bond, so the financial institution goes to investors and say, hey, here's a security, give us cash. And they will issue the security. And the bond will typically pay coupon payments, and that means investors will get cash on a regular basis, either quarterly or half yearly. And the CoCo bond can be redeemed. Now, why is it CoCo bond? Well, what that means is contingent convertible. And that means it can convert into equity of the firm contingent on a particular thing happening. Now, in the scene here, they're talking about their share price declining below a certain level. Usually, in my experience, CoCo bonds are not linked to that. They're linked to a capital number for the bank. And what that means is the bank's regulator will say, for a given amount of assets, usually adjusted by their risk, you need a certain amount of headroom or kind of equity cushion on the balance sheet. So, for example, if you have $1 billion of assets, you may need something like 150 million of equity. And that means if the assets decline in value, that equity can be used to make good depositors, which will make up the rest of the financing. So usually, CoCo bonds are not linked to share prices, but they're linked to the amount of capital in the balance sheet of the bank. I think they've done that just to make it a bit easier to explain within a TV show. But that's what a CoCo bond is, and they are pretty commonplace because it's a fairly cheap way of the bank kind of shoring up its capital position. So a contingent convertible is usually linked to a capital ratio, and the most common one is a common equity tier 1 capital ratio, which they're linked to.
Show the world my true value.
Well, we helped each other do that.
At least for a day.